Hello and welcome to the channel. My name is Kieran and today I'll be giving you a comprehensive guide on how to get investing in the stock market. I'm aiming to give you a detailed breakdown as possible, so I'll be covering everything from how to invest in the stock market, what different types there are available to you, and some of the core business fundamentals you need to understand when making investments. Before going any further, it's important to give some context around investing so you know what you're getting into should you choose to get investing in the stock market. The first of which is understanding that any type of investment carries an element of risk. By that I mean that stocks can go up and down. Therefore, your opportunity for growth is significant. However, if you're investing particularly in individual stocks, if that company goes bust, you risk losing all the money invested in that company. It should also be noted that in that case, investors are the last people to be paid out, and so be mindful of that when taking more risky investments. I'll also include some terminology here that you're likely to hear when researching stocks, such as bull and bear markets. A bull market is when the market is increasing in value, and a bear market is when the market is decreasing in value. However, it's not all bad news. The reason why stock market investing is so popular is that there's a huge amount of upside there as well. This means that with additional risk also comes additional opportunity for return on your investment. The stock market on average returns up to 7% in growth. I'll throw up a graphic for you on screen now, showing that with an initial investment of £1,000 and a monthly deposit of £400, over the course of 40 years, you will be a millionaire. I don't know about you, but when I think of the term millionaire, I think of you celebrities, your footballers making millions every year. However, when you realise how simple it is to actually achieve that status simply by continuous investment in the stock market. When it comes to investing, your mindset is very important. As I mentioned to begin with, no investment is without risk. Now, to illustrate this, I'm going to throw up a graphic on your screen. This shows the correlation between your risk and your reward, with your safest investment traditionally being cash, closely followed by bonds, going all the way up to lottery, where your chances of success are slim, but the potential return of investment being significant. A great visual representation of this is actually a recent Mr. Beast video where he spent $1 million on lottery tickets, and I'd encourage you to check that out to see what his return of investment was. Following this train of thought, it's important to understand the difference between trading and investing. Trading is often short-term, buying a stock cheaply with the aim of selling it at a higher price. On the flip side, there's investing, which is traditionally buying a stock once and holding on to it for long term. My personal philosophy is focused around investing, simply because with trading, you have to be right twice. You have to be right knowing when to buy, and you have to be right knowing when to sell. When investing, if you just buy a good company, hold it long term, you only have to be right once. And of course, as I've stressed in previous personal finance videos, I'm not a trained professional. This shouldn't be taken as professional financial advice, and if you are seeking for that, you should look for a certified professional. Okay, now we've covered the context, let's dive into the guide itself. Now, to begin with, the first question I asked myself when getting involved was how to actually invest in the first place. There are two main options available to you at the moment. One is your traditional broker. In the UK here, there's one clear front runner being Hargreaves Lansdown. They will invest on your behalf, however they will charge a commission for doing so. The second option is the do-it-yourself approach. The most popular method here is using apps such as Robinhood and Freetrade. These are both readily available on iOS and Android devices. When it comes to Freetrade, my personal trading platform, I'll leave a referral link in the description below. This will allow you to get a free stock valued up to £200 when you fund your account. Next, we'll be covering the types of stocks. There are two main categories here: your index funds and your individual stocks. An index fund is a conglomerate of stocks. The most popular is the S&P 500, which lists all 500 most successful companies trading on the US stock market. This means that buying one share of the S&P 500, you'll own a fractional percentage of all 500 of these companies. This means that you'll own a very small amount of all those companies, making you a shareholder, admittedly a small one, in your Apples, your Facebooks, your Johnson & Johnsons, your Coca-Colas, etc. The main benefit of this is that you're already diversified straight away. The second option is your individual stocks. This means that you manually choose the stocks you want to invest in. This focuses all your attention on that one company. And going to that theme of risk and reward, this increases your risk but potentially also increases your reward as well. However, it's important to know historically it's very difficult to actually outperform the market. So if you're just starting out, I'd strongly advise to invest purely in index funds. Now, when we talk about individual stocks, again, there's two main categories. There's your growth stocks and your dividend stocks. A growth stock is a company that's rapidly expected to increase in price. A good example of this is your Facebook, Google, or Tesla. Dividend stocks are traditionally more stable companies experiencing less growth but still making significant profits, and they choose to return their profits to the shareholder by means of a dividend. Final section we'll be covering is actually how to pick a stock, and in order to do so there's going to be some core financial concepts we need to explain. Investing is most intelligent when it's most business-like. Buffett has called these the 9 most important words ever written about investing. Now there are 5 key elements I want to outline in this video. Anytime you're thinking of investing in a stock, make sure that you tick off each of these 5 steps, and if all 5 is satisfied, you should be looking at a financially sound investment. First is the liquidity of the company. This is something that's talked a lot about when it comes to financial statements and auditing. You establish this by taking the company's current assets and dividing it by its current liability. In order for a company to be liquid, that number needs to be above 1. The higher the number, the better. Second is the PE ratio, or the price to earnings ratio. This helps you determine the value of the company. Anytime you're looking to buy a stock, I'd strongly recommend you trying to buy companies under 20 PE. That doesn't mean that you can't buy companies over that. However, if it is significantly over 20, chances are that business is currently overvalued. A great example of this at the moment is Microsoft. It's got a PE over 30, suggesting that it's potentially overvalued. The third is payout ratio. Now, this is only applicable to dividend companies. This number signifies how much of the company's revenue is being paid out in its dividend. Ideally, you should be looking for anything under 60 here. Again, this is only a guideline. However, if the payout ratio is significantly above 60, you run the risk of that dividend being either cut or reduced. A good example of this is at&t with a payout ratio significantly over 60 and therefore more of a risk. Fourth point is debt. You want to be looking at how much debt a company has, both short and long-term debt. I'm not going to be going into too much detail about debt now, however, it is important to recognise the importance of debt and how this can affect the strength of a company's balance sheet. Finally, we're going to be looking at the capital. The key ratio I'd highlight to you here is ROCE. That's return on capital employed. Anything under 2% here is a massive warning sign, and you really shouldn't be looking to invest in that company. This means that capital is not being invested effectively, and chances are it's being poorly led. And you should never be investing in a company that's being poorly led. As a slight appendix to this, I'll also add dividends. Now, I love dividend investing, so it's passive income, what's not to like. However, it is double-edged. By that, I mean it links back to the risk that we discussed at the beginning. You've got to ask yourself, why are they paying that much? Yes, you want to return profits to stakeholders. However, you could also use that for growth internally. A great example of this is Altria. They're a massive tobacco company, and you'll see that they've got a huge dividend of around 8%. However, if you look at the trend of the graph over 5 years, you see that the value of the company is going steadily down, and therefore they're using the dividend to almost tempt people in. Now, a lot of people do love Altria because of this high dividend. However, if the value of the stock goes down more than the dividend is returning to you, it's not a good investment. And the final fundamental I want to leave you with today is knowing when to commit to a stock. A favourite quote of mine by William Eckhard perfectly demonstrates this. He states, either a trade is good enough to take, in which case it should be implemented at full size, or it's not worth bothering at all. This is really important when you're just starting, particularly if you're looking at individual stocks. Don't spread yourself too thin. Do the research, find those good investments, and then operate at a meaningful scale. When you hear about stocks, you hear about the importance of diversifying, and yes, this is absolutely true, and that's why I'd always preach the value of index funds. However, when you're just starting out, you don't want to just be collecting stocks from everywhere. You want to make sure that you do the research on some really good high quality companies if you're going to get meaningful returns from there. With that approach, you'll be building a portfolio over time full of really good quality companies, and you can slowly diversify further over time. I'm doing exactly the same. In my portfolio, I'm very healthcare heavy. However, I've also started diversifying with technology and defense stocks, and we'll soon be adding some consumer goods companies there as well. I'll throw up a graphic on screen now which shows you all the different sectors within the stock market, and in terms of how many your portfolio is considered diversified when there's roughly 30 different stocks in that portfolio. So there you have it, everyone. Hopefully you've all enjoyed today's video. It has been somewhat of a more information heavy video today. Treat it like a guidebook, keep coming back to it, and you'll build up your knowledge over time. And if you have found any of these steps useful, whether it's the definitions, the checklist I pointed out, or even just the philosophies behind investing, please remember to like the video. It really helps out the channel. Please consider subscribing and commenting as well. I'll also leave a link to my recent video showing my free trade portfolio. Again, the free trade referral link is also below. So if you're curious of what my portfolio looks like, please feel free to have a look. Any feedback is greatly appreciated, and I'll speak to you all in the next video.